Even though it's a personal portfolio, it's the majority of my net worth. And so I manage it like a book. There are positions that I won't sell in any market environment, stocks that I've owned for a long, long time that I have deep cost based advantages on. I'm not going to sell them just because there's volatility.
Welcome back, everyone, to episode number 14 of Investing with the Boys. I'm extra excited for today's episode because we have our first guest of the podcast, and that is Vishal from Stock Talk Weekly. I've known Stock Talk for a little bit over a year now. I am very impressed with his abilities as a trader. I'm also a little bit biased when I say this, but he runs probably the best stock trading Discord from all these FinTwit peeps. I am an analyst actually on Stock Talk Insiders, which is his Discord name. And so, yeah, just, I've been following along with Stock Talk's journey since I've known him, and he's been placing really well-timed trades. He's been really good at understanding what's been going on in the market, how to think about things, how to really simplify stuff from a technical perspective, looking at moving averages, what to pay attention to. And so I thought he'd be a great guest to get a little bit more perspective on, obviously what's been going on. There's been a ton around the tariffs, how that's been causing market volatility, and just how to approach markets, and wanted to get his perspective and what he's been up to. So I'll pass it over to Vishal.
Yeah, so I appreciate the introduction there. Obviously, I've known both Logical and Shy for a while now through spaces and just on X by extension. Got the chance to meet Shy recently as well. So that was cool on the Starfighters trip. But yeah, it's been a difficult market. Every couple of years you get a market environment like this where it either precipitates in a quick volatility event, kind of like what we got in COVID, or you get a more sort of drawn out volatility event. I think the most recent example of that being 2022. And I think it's best to sort of use recent examples because, again, a lot of the audience, both on this show and even on the spaces shows that we do, they may not have been trading for a decade, or they may not have seen the throes of 2017, 2018. A lot of new traders, I think probably the majority on Twitter, came into the market in that COVID crash area, whether it was slightly before, slightly after, they maybe used their first stimulus check to buy stocks for the first time or whatever. And so I try to cater my commentary to people who I think we're talking to. I don't think, there are institutional analysts that listen to our show. I don't think they come for a breakdown of the basic TA or a breakdown of, a handful of stocks. They have research groups and, spend tons of resources to figure all that stuff out. So to the extent that we're talking to the retail audience, I think you have to put that context in play. And if you put that context in play, I think the two most recent and best examples are the COVID crash and our 2022. But for people that sat through those, the way they panned out was very different. You know, COVID was a quick, relatively quick crash, a lot of fear, and it was quickly met with fiscal stimulus globally. Really, everyone stimulated, everyone printed money, and we had a quick recovery. And asset prices not only recovered within a few months, but went much, much higher in a short period of time. And that led to this epic 5 year run that we've been on. But again, you look at 23, 24, you'd say, hell of a bull run. You look just 1 year prior to that, and you'll say, wow, it was a brutal year for most stocks in 2022, outside a basket of commodity stocks and, a handful of names that were able to shrug off the selling, most market leaders got killed. So that brings us to today. And, today we've only been 3 months into the year, but it's looking more like 2022 than it does the COVID crash. And I think we can't project using that sort of historical example, but what we can do is say, okay, let's be prepared for a worst case outcome where stocks just don't go higher, where a lot of stocks trade sideways, a lot of stocks go, continue to make new lows through the year. And I think a lot of people aren't prepared for that environment, even though it was just 3 years ago. They've become so conditioned by 2 years of really, really bullish price action where you could have bought basically anything in 23 and held it through even now, even after this 30% drawdown, it probably still did pretty well. So I think that's the backdrop we're in. And then obviously there's a lot of specifics that go into that, whether it's the areas of relative strength that we've talked about, whether it's the tariff situation in the backdrop, where we think the economy goes from here, what individual stocks might outperform. That's where the portfolio questions are answered, but I'm sure we'll get into some of the details of that.
Hey everyone, just want to give a shout out to our sponsor, ValueSense. The landscape of investment research is undergoing a massive shift. Sentiment tracking, automated valuation models, and real-time fundamental analysis are no longer the domain of hedge funds alone. ValueSense is breaking down these walls, ensuring that sophisticated, data-driven strategies are no longer monopolized by the financial elite. If you are interested in getting a leg up on the competition, check out ValueSense at valuesense.io. So let's take a quick look through their platform. You can basically find any stock you want and take a look at their fundamentals, all sorts of momentum factors. Let's take a quick look at Microsoft. Let's see. Okay, gives you a quality rating. Nice to see. So you could see revenue growth. It's giving you historical averages, operating income growth. Wow, charts over time showing you gross profit growth, revenue growth. Basically, you can just use this to do deep dive research on any company that you're interested in. And there's going to be ways to create reports and compare across different stocks. And it's a great tool to basically just start doing your research and finding potential opportunities, getting a shopping list together. Given that, right now we're in a bit of market turmoil. Great tool. Love it. Great UI. Check it out.
Yeah, I think what's really interesting what happened today, we had a little bit of news before the market dumped. And, I hate to pick every little volatility that happens in the market, but today's was driven by some comments by Jay Powell. Basically he was asked flat out, is there a Fed put? And he said no. And I think that's kind of what we're dealing with right now. And you kind of alluded to 2020, where we had a really big issue, and basically the Fed, stimulated, and we got out of that. And so right now, I think there is a liquidity issue, and it's not as easy. So, it might take a little bit longer for all this to play out, and being very, selective about the spots that you're in, knowing that we're potentially headed into a more slowing economy. It's not going to be as easy as it was. We still don't know really the full impacts of tariffs. We don't know how it's going to affect the bottom lines of a lot of these companies. And on top of that, you really have pretty high valuations. Speaking from a relative historic perspective, things are already down 20-30%, even in the mag 7. But even then, I mean, the multiples are still elevated, and we don't really know what that earnings is going to look like over the next 12 months. So, how can investors feel confident investing in this environment? The same way, how can business leaders invest in this environment? Shai, want to pass to you. Have any thoughts there, and kind of what's been going on?
Yeah, I mean, real quick on the Fed put, I don't know, maybe you guys can convince me otherwise, but like I think it's kind of an overreaction that Powell said that there isn't a Fed put. Like, why would he say it? Imagine like if Powell said like, "Oh, we will 100% bail out the market if things get worse." Like that's like that will drive so much ridiculous bid in the market, knowing that there's a high floor and a safety net. So I don't know. I feel like that Fed put thing got way overreacted, and it's just the environment we're in, where something that's like a little off-putting is just getting escalated to something that really isn't that big of a deal. But going off of everything else he said today, yeah, I mean, I don't think anyone should. That was a very bearish or hawkish tone that Powell had today, and I don't think anyone should expect Powell to step in and rescue the market this time around. Like I got from that verbiage today, I got it that he's gonna let Trump be on his own and figure his shit out. He's not gonna help him out, back him out. He's not gonna, because Trump's going to replace him next year. So there's going to be no political cover. There's going to be no incentive to kind of take any kind of bold action. And we're going to have a lame duck Fed that's going to be caught between tightening global regime shift and a domestic policy agenda that is being written on the fly, that's changing pretty quickly. So like what we saw in the past week when the market's trying to rally, people were confusing that rally, that bounce, like April 7th or 8th. Like I was like, whoa, I love seeing that initial bounce. It's like, okay, we have a near term bottom, but we're still not anyways close to where it was pre-Terra Force. Like we're still in defense mode. We're below the 200-day moving average. So the last week bounce we saw, like that was purely just us rallying on a hope that maybe, just maybe, the chaos will slow down. We're getting some more clarity on like what the strategy is. But bear market rallies are brutal for a reason. They seduce you into thinking clarity is returned right before volatility pushes anyone who tries to get comfortable in a trap, and now we capitulate lower to a new low because really the story hasn't changed. I don't know. Vishal, what's your take on bear market rallies? Because you've nailed it on spaces so far this go around where you haven't gone too bullish, even though everyone else has gone pretty bulled up on these like 4 to 5% rallies, but you've been stable on your defense strategy.
Yeah, and it's different for me last year, right? Like last year on the dips, I was saying buy the dip, and I was saying it pretty aggressively. I was getting to the point of, I mean, you guys remember the spaces we had, the debates. I was getting to the point of just like fighting bears over saying not to buy the dip, and I haven't done that this year at all. In fact, like during none of these corrective periods, and people who are in our community know this. I post what I'm doing. I've not been saying buy the dip. I've been saying, hey, use the opportunities on the upside to hedge your portfolio because this is not a favorable economic environment. And I think what the distinction there is the backdrop. Last year when the markets were correcting, you had a lot of fear mongering, but I felt it was low ammo. Like the stuff that people were grabbing for to fear monger about the economy, they were picking up like, like what happens when people have to pay student loans again? Like that was a big narrative. And like, it was a nothing burger. And Bill, who we all follow, did a great job of like counteracting that narrative early on. We saw people talking about like credit card usage, and you just take one glance at the historical data and you're like, that's not really an economic concern for Americans. And so there were all these anecdotes, if you will, by which we got scared. And I felt like none of them had a ton of validity. This year, I think things have changed because we've gotten to a point where we're at the tail end of the cycle, and that in and of itself complicates things. Like all else being equal, right? If there were no other things to worry about, cough tariffs, like if that wasn't in the backdrop, we would still be in a sensitive macroeconomic period because you're getting to the end of the policy cycle where the Fed has to make a decision of when they're going to start easing or not, right? And I know people have short-term memory in this kind of market, but just rewind your mental clock 6 months. That's what we were talking about. Markets were reacting based on how soft the economic data was, and they were reacting positively to incrementally soft economic data. Why were the markets responding positively to that? Because they wanted the first cut as soon as possible. Speculators wanted the first cut. So they're like, hey, even a slight miss on labor numbers, we're going to bid the market up, right? 6 months ago, that's the action you were seeing. Now that's changed because now people are interpreting economic weakness as a recessionary indicator, not as when are we getting the first cut. Now people are interpreting it as, oh shit, we may be getting a recession, because they're contextualizing the drop in data with the change in the backdrop, right? Last year, a slight shift in labor data shouldn't spook anyone. This year, a slight shift in data should be spooky, because 2 or 3 more incremental negative labor prints and you get a recession. And, then all bets are off on projections, outlooks, multiples, valuations. All bets are off in a recessionary scenario, especially if it's a global recession. The last thing I'll say on that topic is about the Fed put, because I actually disagree with most of the commentary on this today. There's always a Fed put, okay? And it's not because like they're bailing out the market. Like that's what it looks like, right? To an onlooker, it's like, oh, the market crash, stock market crash, so the Fed is cutting rates. It's because of the second order implications of a market crash. You always hear this like phrase on Twitter, like, oh, the market's not the economy. It's not. But the market has impacts on the economy. And I talked about this on Spaces today. Like when the biggest companies in America get their valuations cut in half, which quite literally has happened for some $100+ billion companies in just the last month, right? Like think about if you went from being at the start of the year a $250 billion company, and now you're a $136 billion company. Like, what does that change about your business? Well, it certainly changes the amount of money you can spend. It probably changes the amount of workforce you can hold, right? That you can sustain. It probably changes your cost cutting initiatives, your margins. Everything is going to change. Your ability to raise capital. So we have, by allowing a massive stock market decline, you fundamentally change the short term picture for major American businesses. That has second order impacts on employment, second order impacts on consumer confidence, business spending, capex, all those categories, which make the economy churn, right? So that's what matters. And that's what the Fed is bailing out. The Fed is never bailing out the market in a vacuum. The Fed is bailing out the implications of a down market, right? Of a market that's in the dumps for years at a time. And hopefully we're not headed back to that type of market, because I mean, most people won't be able to stay invested if we're flat for 10 years.
No,
Yeah. Sorry, go on.
Yeah, real quick. I mean, 100%. Like that's why when people talk to me like, oh, like the tariffs just got implemented right, like what, a week ago, like there should be somewhat of like leeway on how much is going to affect the economy, because it really hasn't been implemented yet, just started. But no, the psychological effect from the month leading up to the tariffs being launched, that's what the job has been done already. The second guessing that's happening on C-suite, the second guessing from consumer spending, that C-suite second guessing you just called out right there on with the hiring freezes, working capital, like that trickles. Business spending will slow down just from that second guessing. Like it's a real thing. So there is a Fed put, but the psychological effect from this tariff war has been affected right now across the board, and it's going to be a really ugly earnings cycle where you're just going to be so noisy. You're not going to get any kind of clarity, and that confidence that we've been all accustomed to for quite a while is removed. And it's going to take some time to build that back up. And it's not going to just be Powell saying, "Oh, we're going to do QEing, quantitative easing, and we're going to be all just fine." Like, no, it's going to take some time to build that trust back and that confidence back from enterprises, consumers, and that's why we're in a pretty ugly digestion period. And I don't know. I'll pass it to you, logical. But like, do you think that even if we get East versus West kind of rumor of like, oh, it's actually not as bad as feared. Like, what will it take for you to gain the confidence to get into the market? Is it just purely technical, or is it something like you have to monitor policy wise? Or like, oh, that's the green light I needed. I'm going full bull right now.
Yeah, couple thoughts there. One thing I wanted to add on quantitative easing, I think, we've been basically doing quantitative tapering, and it's been becoming a lower amount as of the last Fed meeting. I think it's basically back down to zero. It's like 5 billion a month, which means that they are selling debt on the open market. But I think, recently we just had basically last week a liquidity crisis on almost, I would say, kind of like a unwind of a lot of bond selling. And I think that has to do more so with a lot of leveraged US traders in the bond market. And so when these yields start going up, you get a lot that basically is just a signal that bonds have been selling. And if you have a super leveraged position, I know people who run very leveraged bond portfolios essentially. They are like, I mean, levered to the tits, like 6x their portfolio, 10x their portfolio in TLT essentially. So what happens is when those bond prices come down, they're forced to deleverage, and that, selling begets more selling. So I think one thing that we need to think about when it comes to QE and the Fed put, I think there is something outside of what people just, typically considers like, oh, the Fed put is, cutting rates because of the slowing economy. We want to encourage people to, borrow more money. There's also, I think that they would actually come out and support the bond market through QE and buying those bonds and expanding their balance sheet. So that is something that can keep happening. And I expect that to potentially happen a lot sooner than a rate cut at this point. Because we can't be having our bonds, trade at greater than 5% yield. Someone needs to come in and backstop that. And, otherwise, what are we, like some emerging market like Venezuela? Like, we need to be the kind of, reserve currency of the world, and we need to continue to have that. So people need to, because of all these trade deficits we've had, people own our debt, and so they dump our debt if they felt that we weren't good for it. So I think they need to come in and basically support that. In terms of your question on, what would it take me to go full bull on this market? And I'm happy we're talking about this because maybe we can get a little bit more micro in the combo. I think that's a little bit more interesting. I am very invested in this market right now. And I know that's, we all have different styles. I know, Vishal can kind of talk about his when we make it over to him and get his take on these things. I know how he manages his money, and he alluded to, kind of being a little bit more cash heavy and maybe on the sidelines a bit until like the price action fixes itself. I'm I am very long in this market. I do have some hedges in place. I am very active in my form of management in this kind of environment. Obviously, stocks are really weak right now. The S&P is very weak. I'm on edge, but I think there are still a ton of opportunities in the market, but you have to be very selective in where you're looking. And I think we can all agree on that. Um, and I post my portfolio updates all the time on Twitter, keep it in my pinned tweet. And, over 60% of my long exposure is in biotechs. I've mentioned that in the past. And these are, carefully selected after, speaking with some really great fund managers in the space, kind of bouncing off ideas, understanding, what's going on. Majority of that exposure is actually in the commercial stage biotechs. So, and the way I justify that is because we are about to be in an uncertain economic environment where, we're going to see a lot of these businesses start to slow. We're going to start seeing guidance is pulled from tech companies, consumer companies. That's why they're front running those moves and dumping these stocks. But I don't think that people are going to stop buying their medicine. I think that they're going to continue, these companies are going to continue to grow. I've talked about a company, ARQT. We've talked about it on the show several times. I know Shai owns it in his small cap portfolio. This is a company that sells their, eczema cream, right? And they're recently commercially approved, just started their launch a few quarters ago, growing 50, 60% quarter over quarter. I don't expect those trends to stop. So that's what I mean by being selective in this environment. I think while, consumer and tech stocks are coming into these with pretty high valuations, we're uncertain of the forward forecast. They're probably going to pull guidances. We're probably going to see a lot of pressures come onto those companies. Um, why would I own something like that when, people are coming in, they're like, oh, 25, 30% discount on, big tech or whatever. Uh, but we don't know what those earnings are going to look like. They're going to pull guidance. Meanwhile, a lot of these healthcare biotech names, I look at biotech as, and especially commercial stage biotech, as kind of like that mid cap, mid cap growth areas of healthcare that are really starting to hit the ramp of growth. And, whereas consumer and tech companies are pulling guidance, these guys are going to be doing beats and raises. They're going to be, at the minimum, maintaining guidances. I don't expect people to pull back spend for medicines and treatments. And when it comes to the tariff impact, I know we talk about pharma tariffs and whatnot. Look, something about Arcutis, for example. Arcutis has 90% gross margins. That means their costs of goods are 10%. So let's say we slap 20% pharma tariffs. That's a 20% increase in COGS. That reduces your gross margin by like 2%. So, I mean, yes, it's a hit, but like it's not a hit, right? Like in comparison to other things. And I think what the really tough sell is, and I know I'll get a lot of pushback on this, is like, yeah, but dude, right now, like every equity is getting sold, and I 100% agree with that sentiment. I've been getting kicked. While I've been like down and getting kicked while I'm down owning these things because I've been a little bit too early to this thesis, and I think that the market hasn't really differentiated between these different places that can do well. And so I think earnings can be that catalyst because, again, some companies are going to be pulling guidance. They're coming in with lofty valuations. Other companies are going to be beating and raising, at least maintaining. And I think investors are going to look for growth where they can find it. Think back to 2022, even when we had that kind of down market, energy, commodities, those did well. Right now, we're in kind of a different environment where it's not an inflation driven. That's not where those, we're going to be in a situation where in a slowing economy, I'd want to be invested in healthcare. If I'm in a recession, that's what I want to own. So that's why I feel comfortable on the commercial side allocating to that. When it comes to the clinical stage biotechs, that's probably a fourth of my allocation to biotechs as a whole. Obviously, they're a bit more speculative, but dude, some of these things are down 75% in the last 6 months, and they're trading down to zero enterprise value. What that means is the market cap is around the cash on the balance sheet. So you're basically paying cash value for these companies, and all of the upside is basically priced at zero. So I think there's a lot of really appealing and attractive names in this sector, and they're not going to be impacted. Like phase 3 trials are going to move forward. And I think that rates will come down, which has been a big headwind for this sector because M&A is a big part of this sector. Cash-rich biopharmas filling up their M&A pipelines through M&A hasn't been happening because these guys have 10 billion of cash in their bank. They could easily just park that and get 4 or 5% risk-free. But you know what? That rate is definitely coming down. Even today, after Powell's comments, we saw TLT was like basically the only thing that caught a bid. We know because the market's looking past any sort of near-term inflation bumps to prices through tariffs, and we're looking forward to potential recession. And so I think ultimately a slowing economy is going to bring down rates regardless of what happens from here to there. And yeah, I mean, if they can't collect 4 or 5%, then it becomes a lot more attractive. And if you're not bidding these companies now, then your competitors will. So I think it'll be a bidding war before we know it. One last thing I'll say before I pass it around is, I'm talking about themes that can do well in this environment. I think also Latin America is very interesting because Latin America is actually what I would call the tariff winner because they got basically the lowest rates, the tariff rates. We don't even have like huge trade with Latin America compared to other countries. So they're kind of like out of the headlines right now. We saw what happened in Argentina with Javier Milei a couple years ago. He got elected. He started, getting that economy under control. This week we got election results from Ecuador. That's another Latin America country that, their bonds started trading up because, they know that there's that right-wing shift, that political economic shift happening there. This year, I think you get the Chile elections. Next year is Colombia, which the right wing is leading there as well. And then in 2027, I believe you have the Brazil election. So there's like this big shift going on in Latin America. They're out of the tariff headlines. And actually today, while, SPY was down 3%, some of the Colombian banks I own, like Bank of Colombia was up 2%. AVAL was up 8 or 9% by the end of the day. So there's clear strength in Latin America. So yeah, I think I am very bullish, but in certain things you have to be very selective in this environment. And when I have other exposure that I've been adding, I have to pair it with shorts, and that's kind of how I'm looking at it outside of those two themes. But yeah, maybe Vishal, maybe you can talk a little bit about how you're taking this and what you're looking at.
Yeah, I mean, I wouldn't classify myself as either a trader or investor. I would classify myself as both. And like the main portfolio that I run is like I kind of treat it like a book, even though it's a personal portfolio, it's the majority of my net worth. And so I manage it like a book. There are positions that I won't sell in any market environment, stocks that I've owned for a long, long time that I have deep cost based advantages on. I'm not going to sell them just because there's volatility. The likelihood that I go red on any of those names is like pretty near zero unless there's like some sort of world economy ending apocalypse style event, which I guess is always a possibility. But so there's, stocks like Amazon, Robinhood, Tesla, I'm not selling, and like, am I going to take drawdowns on them? Absolutely. I mean, all those stocks are down a lot year to date, right? You'd think my portfolio would be down 20 or 30% year to date. No, it's only down 2% year to date, even though my biggest holdings have all been crushed, right? And the reason for that is because we've made trades in the right industries, right? We've found long opportunities in the right industries that have performed well in this environment. Embraer is obviously one I've talked about a lot this year. It's come off the top pretty significantly, but that stock's still up 16% year to date. I talked about today, I posted a list of some relative strength industries for people to be watching. And Like every stock I put on that list is not only above the daily 9 and 21 EMAs, it's above their 200 days as well. Like none of these stocks have been sold during the market sell-off. And what that tells you is, yeah, some of them are small and mid-cap stocks, so they have a better odds of dodging the selling in the S&P 500. But it's not just the S&P 500 that's selling, right? I mean, you look at the sell-off that we've had in XBI and IWM, you'd expect a lot of small cap stocks to be down. And guess what? A lot of them are, right? A lot of them are down. As you mentioned, some biotech names are down 75% off the highs. A lot of small cap names, non-biotech, are still down 60, 70% off the highs. So I wouldn't look at that basket that I posted today and say, well, they're small cap names. Of course, they're not down a lot because, again, a lot of small cap names are down a lot. So, you look at some of those industries that I posted today, aerospace and defense, Kratos, Leonardo DRS, Mercury Systems. These are just 3 names. There's a basket of about 9 or 10 that I've shared in our Discord. But those are the 3 names that are all holding up. Like, when I say relative strength, that's honestly an understatement. Like, they won't even sell these things below the 9 EMA. Like that shows you that like shareholders in these stocks are saying, no, I don't care that Amazon's down 10% today. I'm not selling this $2 billion mid-cap defense stock. Why? The only rationale for it, in my opinion, is that there are some themes that, in spite of all of this tariff noise in the background, are still valid themes. There's not many, because let's be certain, if these tariffs stay in place as they are, the global economy will suffer. Global growth will slow. So most stocks, most industries are going to be impacted. But you could go through that list and say, why are each of these relative strength? Well, let's talk about the U.S. border plays. Geo and CXW. I currently own CXW. It's Core Civic. They do servicing for detention of the U.S. border. Target Hospitality is another name that's linked to Core Civic on that same deal. You look at those names, you ask yourself, why is there a bid? Well, that's a Trump administration priority. We know of all the places where dollars might be moving, U.S. border security is an area where the dollars are not moving. And in fact, more dollars are being invested in those efforts, right? So that's one of the few industries where you can look at and say, we're probably going to see growth in U.S. border exposed plays, U.S. border security exposed plays. And that's why you're seeing the technical relative strength in those names. You ask yourself about the aerospace and defense, you say, why is that showing relative strength? Well, what's the thematic we're seeing globally right now? Defense spending, but not from the United States. The U.S. is always going to spend on defense. Yes, we set a new record with a $1 trillion defense bill. But all these other smaller countries are saying, you know what? We need to start spending our own money on defense. The major beneficiaries of that, not your legacy defense companies. They're your smaller mid-cap defense companies who have specialized technologies, who have competitive advantages and differentiations, and can meet these next-gen technology contracts in areas like drones, autonomous weaponry, right? The areas that the new age defense money is going to go. Specialty insurance, that's another place. It's performed well in many economic slowdowns, specialty insurance. But there's a lot of small cap specialty insurance right now. No sellers. Heritage Financial, HRTG, this is one we've owned for months now. Look at the year to date on Heritage Financial. The stock's up 47% year to date. Okay, and not a single day is it being sold. Like the day when the market was down like 7% intraday, I looked at my portfolio and HRTG was up 2%. And I'm like, what is going on? Like everything was getting sold that day. So specialty insurance, another area. And again, there's a lot of historical precedent for that. Pawn shops, we talked about that. EZPW, FCFS, both of those. Beautiful strength. I mean, no one's selling those names. Now, could you say it's a recession indicator? Maybe, but pawn stocks, there aren't many of them. There's a handful. They're all doing very well in this environment. The rare minerals and metals, that came up recently with the reiteration from the Trump administration that they want more U.S. production of those. My favorite name in the space for a long time. I did really well trading it last year, got out earlier this year, re-entered recently, got shaken out, but this thing has been ripping for the last 3 weeks from the 8s to the 13s now, making new 52-week highs. PPTA, Perpetual Resources, they're going to own the first significant antimony deposit in the United States. UAMY, the new IPO, USAR, US Rare Earth, that thing has been ripping things up like 200% in a couple of days. Why is that area an area of focus? Because we don't have any rare earth minerals and metals infrastructure in this country, and we need to start building it. And they're going to be beneficiaries to that. And whether or not the tariffs go on or off, that's going to continue to be a priority. Even if all the tariffs came off today, U.S. rare minerals is still going to be a priority. So, that's 5 industries. Logical mentioned some biotech names too. There's some crypto names that have shown tremendous relative strength. There's probably 6 or 7 very specific industries with 6 or 7 stocks in each of them. I just mentioned 2 or 3 in each of those categories that you can find and that you can hang your hat on. And the beautiful thing about buying stocks in a market environment like this is you don't have to have a long leash. You could throw a dart in one of these names that's holding up well in this environment and say, you know what, maybe it ends up being a performer for the whole year, right? I can take a shot at that. And if it doesn't work, if these stocks start breaking down, cool. You take a 2 or 3% loss and you get out. It didn't work. The chart broke down. You're looking at some of these names I brought up, right? They've been respecting the 21 EMA and the whole sell-off. Cool. Use that as your line in the sand. Next time that stock is kissing the 21 EMA, buy it and mark that as your point of risk. If it goes up and keeps going up and keeps building and no one sells it for the rest of the year, bang on. You just have an amazing trade for the rest of the year to hang your hat on to help your portfolio. And it took you 2% of risk to undertake that, right? I mentioned this on Spaces today too, and this is the last comment I'll make on this, but a lot of people think like the market's like a blackjack table. Like if I invest 100,000, I have 100,000 at risk. You don't. You can choose to take tighter risk. That's the beauty about stocks versus any other gambling environment, is that you can define your risk as long as you're not buying like options that are going to move overnight. But if you're buying equity and you have a platform that allows you to trade overnight, you can define your risk and say, look, if this thing goes below the 21 EMA, I'm going to be out. And I may take a loss. Maybe it'll rebound and come back up. But that sort of risk definition is what allows you to not get killed in markets like this, as opposed to people who are buying the dip on names they like and then buying the dip again 20% lower and then buying the dip again 20% lower. That kills portfolios in market environments like this. And a lot of investors are going to hate to hear that, but it's just the truth.
No, I want to go to Shy in 1 second, but just one thing that you mentioned, I agree, man. Like, I look at strong charts right now. Like, I was just looking at Dollar Tree. I think I just texted you about it because you were mentioning the pawn shops. And, I'm still obviously a little uncertain with some of the imports from China and how that's going to impact that business. But the CFO just picked up $1.2 million worth of shares, increased his ownership by 53%. I was like, let me just pull up this chart. Dude, it is above every moving average, the EMAs and whatnot. And if we are headed into a slowdown, I mean, a name like Dollar Tree could work pretty well in line with some of those pawn shops and what you're mentioning. So I agree. Like if it ends up losing steam, I'll take a little loss and shrug it off. But it might end up being a great diversification that ends up outperforming and helping the rest of my portfolio. So totally agree. Makes a ton of sense. Want to get Shai's thoughts on kind of, how he's been going. I know he's all in on the 4th industrial revolution, as he's been talking about a lot. But, I honestly, for he's been owning, a lot of stocks in the tech sector. They've been getting hit hard, but dude, he's been managing extremely well. I mean, his risk management has been very good. He's been hedging where he needs to, for that specific risk and allocation and exposure. So yeah, anyways, I just want to get your thoughts there. Best of breed stuff. Let us have it.
No, I mean this is why investing is so much fun. Like we can all look at glass and just think, oh, it's half full, half empty. Oh, it's a little. There's just a lot of different flavors we can have in the market right now. Like for me, you guys are listeners. You guys are fully aware. I'm a thematic investor, 5+ year out outlook. It's rare for me to buy or sell a position, like sell out of a holding, and I'm learning skill sets along the way of like when I should cut them loose. Like Unity, I should have cut loose in 2023 when I saw the prior management just take that company down with their poor corporate governance. Snowflake, maybe I should have just hit pause in 2024 in beginning where it was clear signs that they're treating the whole year as an investment cycle and their stock was going nowhere. And just revisit it once they are able to get all the AI compute necessary to create these AI products. So like there's definitely lessons learned. This is not the greatest way. Like I'm learning lessons along the way. However, like Logical is fully aware of this. Like, I don't go in and out of position. I don't make that many trades. And even when this risk on pullback we see in the market, like my fourth industrial revolution, like what I've been focusing specifically and niche within that, this pullback is the new age of defense. Like I call it the DoD budget's evolving and it's a new age of defense bucket. You have the Palantirs, the CrowdStrikes, the Axons, the Cloudflares, the Rubrics. Like those names are going to become a hot pocket going forward in the agentic AI world. And if you look at their year-to-date performances, like Palantir's up 23% this year, CrowdStrike's up 11% this year, Cloudflare's green. I think Axon's flat. I think Rubric is flat. Everything else is getting punished. Those names aren't. So that is showing a total relative strength. And I think that's fortunate enough. Like the reason I chose that bucket within the fourth industrial revolution to focus on this macro driven pullback is it has a combination of growth, clearly, because cybersecurity and software has a ton of runway in the agentic AI world about to enter, but it's also somewhat defensible because the stickiest component of any IT budget is going to be security, cybersecurity. So if things get significantly worse, that is going to be the last lever if they decide to pull that lever, which I don't think they will, because you just can't save dollars on security in enterprise these days. You just can't. So I was like, all right, that's a good combination. I'm going to allocate my soldiers towards that, where I would love to add to Snowflake at 120. I would love to add a Unity at 16, MongoDB at 150, but like that the risk isn't there. The risk and reward is tricky with those names because Unity is going through a narrative change, and it's honestly a speculative position because they're just a brand new company and a new management. And the other two names, MongoDB and Snowflake, and same with Trade Desk in the 40s, like those three names, they're going to get hit hard in any kind of recessionary environments. Ad tech is going to be the first lever being pulled in a recessionary environment, and Trade Desk will suffer. MongoDB and Snowflake are software names with a consumption model. When business spending is going to kind of take a hit due to the second guessing from C-suite in this environment, those are the names that are going to get punished. So I'm being very specific on why I'm adding to these names. Like for Cloudflare example, they had Vishal loves sell side research and especially upgrades. Like I don't know if you got a chance to see their upgrade from today, but like Mizuho, they're like a tier 3 in my opinion, like not the greatest shot, but it was an upgrade in this environment. It was kind of repeating a lot of the stuff I was saying, where the company's kind of still perceived as just a CDN or a content delivery network or some kind of security edge provider, but like that isn't the full picture anymore. They're fully evolving into what I call the AWS of the new internet, providing like a decentralized, globally distributed platform where compute, storage, security, and inference all can happen at the edge, and that's going to be vital, especially their new product Workers, which was called out in the note from this morning, is now being adopted by thousands of developers. They have so much talent being hired from ServiceNow, and I'm blanking on the other one. I wish Sam would know this other one, but like Matthew Prince is hiring talent around him to sell Workers, and it's happening. It's scaling, and it's not just a feature. It's going to become a new paradigm in this agentic world we're about to enter, where you need to be able to access, control, secure gateways, and you also need to be able to real-time traffic inspection all at the same time and move away from VPNs towards fully identity-aware networks. Like that's the way the world's going towards. So you guys probably don't even know it, but like every website you go on is powered by Cloudflare. And it's just one of those monopolies that is so under the radar, but it's also not, because the market sends a ridiculous premium valuation to them. Like, I don't know what, right now it's probably like 100 times EBITDA multiple. I don't even know what it is. It's a ridiculous multiple, but it's always been expensive. And I hated adding to it in the 80s when the multiple was that high, but also I see them as a monopoly and an early disruptor in a secular growth theme, a ton of runway, and they have all the makings as the next mega cap. I'm hoping their fundamentals catches up to them. Maybe their CAGR's more closer above 30% for the next 5 years, and then their margin expansion opportunity catches up with them, and then they slowly become like the fundamentals catch up to their valuation, hopefully, because right now it's freaking nosebleed valuation. But there is a lot of names in the growth world where it's risk on and it's somewhat defensive, and that's cybersecurity. I just love that space, and I love security. And Rubrik was a new name that I started adding aggressively under $50. And if you've seen their earnings reports, past two earnings cycles, like what they're doing right now is really working, and it's becoming a really nice complement to CrowdStrike, my portfolio, where they don't overlap each other in the cybersecurity space, but they somewhat complement each other. And especially like the outage, for example, that CrowdStrike caused, Rubrik, that was Rubrik's time to shine, where they were able to essentially be a data security layer to make sure that all the data is not lost. And that was the time for them to shine, and it worked. And yeah, I don't know. I know this is very, I am in the minority among this group right now on talking about this is what my strategy is, but yeah, it's just
It's so funny because it's always like Shy and Sam, and we don't have Sam here today, but it's always 2 to 1. Like I'm just talking about some obscure stocks at like reasonable valuations, and it's just like Shy and Sam, and they're like pounding the table on all these software stocks. And the thing is, my background is actually tech, so like I totally love a lot of those companies, but it's just like I don't know, the math in me doesn't let me pay those
the
valuations for them.
the thesis. I mean, the difference is like valuation is a big rock for you. Valuation is a little rock for me. It's like that's like I honestly, if you want to TLDR, it's disagree with me or not logical. But that's a difference. It really is on our strategies.
No, that makes sense. And the problem, like, the thing is too, like, even in a market downturn, like, here's the thing, right? When we're in a bull market, everything goes up. Nobody cares about valuation, right? Like, Palantir can trade at 100 times sales, nobody cares. Freaking Cloudflare can trade at God knows what valuation, and nobody cares. I think when we get into a bear market, an environment that we're in now, I think people will care, but still, to that extent, the very high quality companies that you're talking about, the CrowdStrikes, the Nets, the Cloudflares, etc., they're never going to trade at cheap multiples, even in a market downturn. Like the quality names are still going to be expensive, and I don't know if they're ever going to get to a price that I'm willing to pay for them. Um, yeah, Vishal, I mean, what are your thoughts on valuation at this point?
Yeah, I mean, I think I'm somewhere in between both of you in terms of it being like a little rock or big rock. Big rock. I like that analogy. For me, it's contextual. I think like having a objective view on valuation, I think is a silly idea because, like you mentioned, during bull markets, people don't care, and that's true. Like, especially, and bull markets can last a long time. People keep like referring to like the idea that companies only trade at 100 times sales at the end. Like, no, they can trade at those valuations for years at a time, and very often the most expensive stocks are the best performing stocks. Very often, especially if you look at the most liquid, like, in this last couple of years, like, you look at a handful of your super performers, they got to be very expensive. Not all of them, but most of them got to be very expensive and still had bids underneath them. I think what happens is that people mischaracterize multiples as like industry representative. I don't think, like, I think the multiple needle, if you will, like this idea of things trading at 20 times or 30 times or 40 times or in some cases 100 times, is an immediate indicator of whether the stock is a good buy or not. That philosophy I disagree with. I don't think you can look at valuation in a vacuum. I think you have to look at contextually with the growth of the company, obviously, with the space that they're in, with their competitive position, with any sort of moats they have. You have to factor all those in and then construct some sort of market premium that you believe the company deserves and assign that to a basic DCF model. And then you have your valuation. The issue with that, I think, especially in today's environment, is a lot of people are focused on forward valuations, right? Like, yeah, you have some legacy guys who will bring up trailing P, and they only care about trailing P. I think Dan Niles was on our show a couple of weeks ago and brought this up, and he's a tech investor. Okay, Dan Niles is a tech investor, and he said on our show, he's like, I look at trailing P, not forward P. He's investing in growth companies, but he still looks at trailing P instead as a priority. Why does he do that? Because he's like, forward P, in his view, tells you nothing. Forward PE, in his view, says this is what the projections value the company at. But, he brought up a great thing. He was like, I hate when CEOs give multi-year guidance. I agree. I hate that. Because what you're saying by doing that is, I know what's going to happen in the next 3 years. In the macro backdrop, in the competitive environment, in the inflationary environment, I know what's going to happen. And I have these base assumptions, and that's what I'm operating on to give you this guidance. That's ridiculous. That's fool's gold. Are people going to be right about 3 and 5 year guidances sometimes? Yeah, if all the music plays beautifully, right? If everything goes according to plan, then yeah, you can be right about a 5 year outlook or be close. But again, because it's a forward-looking market, because people want growth, because people, stocks move before the story moves, right? Because all these things are true, people lean on the forward valuations and they start to describe whether they think a company is cheap or expensive. NVDA is a great example of this. When NVIDIA was trading, I don't know, $1, whatever the highs were, $1.20, $1.30, and I was on Spaces telling people that to me it's not a buy. The first thing I heard from people was, well, it's cheap, right? It's cheap on a forward basis. It's not expensive. And I'm like, yeah, on a forward basis, though. The keyword being forward, right? And you don't know what's going to happen to data center in this next 12 months. And since then, obviously, NVIDIA has gone down a lot, but I won't say that it's been an NVIDIA problem. The whole market has gone down a lot. But, over the next 12 months, you'll see that story unfold, and you'll see if that, if the recovery is in play and if NVIDIA is going to go back to being a almost $4 trillion company or not, right? I think the odds are lower than 50% of that happening, to be frank. And you'll tell that to a lot of NVIDIA investors who think it's going back to the highs next month. I don't know. I think people's expectations have gotten out of whack as a result of forward valuation. People see something they're buying and they go, well, on a forward valuation, it's cheap. It's down 20% and it's cheaper now. I have to buy it, right? That's the kind of line of thinking you're seeing. And I think it's dangerous. I think the way I look at valuation is that I look at valuation as a attraction point for new entrants. I look at it as one of many factors that makes an equity attractive. When I think of stocks, I think of them as tickers with stories, okay? And part of that story is the fundamentals. Part of that story is the industry you're in. Part of that story is the growth and the growth of the broader industry. Part of that story is your technological moats. And part of that story is how well you fit into the current macro backdrop. And I think you take a combination of all those things, valuation being one of them, and say, is this a good buy? Is this a story that's going to attract more buyers? And it's sort of a catalyst trader's line of thinking, but I don't think it applies to just catalyst trading. I use that line of thinking in my investments too, to say, is there enough factors about this stock, technical factors, fundamental factors, valuation factors, to where I believe that more people will want to buy the stock than already own it? And if the answer to that is yes, then I buy the stock. If I don't think so, then I don't. And I've bought stocks before that have traded at 100 times PE. I'm probably not going to hold those stocks for very long, to be fair. But I have bought stocks that have traded at crazy PEs. I've bought stocks that I thought were cheap, But in both cases, I didn't buy them because they were expensive, and I didn't buy them because they were cheap. It was just one factor in a multi-factor analysis. And I think more people need to think of valuation that way. I think living and dying by the balance sheet is a dangerous game. And I think a lot of people have been trained to think that way about stocks because, they read The Intelligent Investor or whatever, and then they feel like, okay, I have to think about valuation in that way. Valuation always comes to call. But the tricky part about thinking that is, well, yeah, market crashes are going to happen. But once we get back into a bull market, it tends to be those expensive stocks that wind up leading again. So you have to, again, measure it with the backdrop to say, am I buying in a bull market or am I buying in a bear market? And that should affect your decision making there. You should be more willing to buy a stock that's expensive on paper. You should be more willing to buy it in a bull market, because I think in a bull market, high valuation is actually indicative of a stock that has a lot of things working for it, which is why it's expensive, which is why the price has been bid up. And in a bear market, I think an expensive valuation is a reason to sell. And so those things work very differently, right? In a bull market, a high valuation can give you momentum, can give people confidence in the story. In a bear market, it does the opposite. So Yeah, I think you have to contextualize it like all other things. I know that's probably not the answer people want to hear. They're like, tell me a PE ratio that you'll buy a stock at. What's your PE floor? But I just don't operate that way. So yeah.
No, that's totally fair. I totally agree with you. You can't look at it as like a vacuum. And the market just doesn't work the way it used to. So people who are like market historians are like, I love the charts that are like, oh, SPY's at a historic PE now, compared to the average. Like, dude, back then the biggest company was like L'Oreal. Like, dude, now we have like globally diversified big tech companies that are, I mean, operating at 30-40% gap net profit margins. I mean, this is like above and beyond. They're growing for the next 10 years at like 10-15% on the top line, 20% on the bottom line, no end in sight. They have buybacks, EPS engineering, all sorts of stuff going on. Now they're most of the big tech is starting to do dividends, and they're going to do dividend growth, and like, so yeah. I mean, I just find it silly when you don't add that context. So appreciate those comments. I think we should probably make our way into some wrap-ups for the episode. This has been a great chat. I want to hand it over to Shai. Leave us with any final thoughts for the day.
Yeah, so guys, I wouldn't get bullish in quite some time. Like we're entering earnings season and it's gonna get uglier before it gets better. I think you're seeing some pre-reads this morning or today on AMD NVIDIA chips or NVIDIA like getting some kind of a hit due to all those Tier 4s. Like I think what Dan and Vishal was saying right there on using trailing valuation and forward valuation, I think that's spotlighted in this environment even more because forward valuations are going to get cut now. There's going to be earnings revisions downward, and it's going to potentially get worse. Not just this quarter, the quarter after next quarter as well. And if this is the last over 6 months, like it's recessionary, and we might enter the great financial crisis. I don't think we'll get there, but if this lasts until Q4, like we will, in my opinion. So, I am going to be very quick with earlier in my spiel on this episode. I was like, it's hard for me to sell a position holding. Like I know the company inside and out. Every holding I have is high conviction. I have a handful of names I'm cutting loose this cycle, most likely. I'm waiting to see my higher conviction names that are on my watch list. If they experience some kind of gap down due to this macro environment we're in, which I'm writing off as a one-off, not really thesis breaking. It's just pieces on the board's changing. So now they're getting hit in the near term. I want to capitalize on that in 5+ years. I have that list of names I want to add to my portfolio. And I also have those lists of names I'm cutting loose. If those higher conviction names on my watch list have that gap down, that valuation is more digestible for me to get in. So I have a game plan entering this earnings cycle. And I think a lot of you guys, if not everyone, needs to have a game plan because there's going to be some wonky moves in the near term, some wonky moves. And you don't want to have paralysis when that happens and sit on your hands. You want to be prepared, capitalize on it. If you've done the research, gain the conviction, and you want that position in your portfolio, capitalize on it when it's down like, I don't know, 20% on one afternoon on a miss that wasn't thesis breaking, but earnings revisions due to Trump and Z just hating each other. Take advantage of it. So I'm trying what I'm doing right now is raising cash. I only have a 5% cash position now. I unfortunately made some big time life purchases recently that now my DCA plan is a little slower than usual. So I will be hoping that we recover a bit in the market so I can build my cash position at least 10% come the time where growth is really going to be reporting their earnings in a month. So yeah, that's my plan. Don't get greedy. Live to trade another day. Be prepared. Have a game plan because volatility will be the theme of this earnings cycle, and you got to be prepared. I don't know, Vishal, what's your final sign off? I also appreciate you hopping on. Love the stuff you talk about on Spaces, and you offer a lot of alpha and a lot of different angles, and that's all the listeners can ask for is like we could be wrong, you and I, or logical. It's all about angles and making the listeners just think about, oh, that's an interesting angle, and let them do the research, etc. So pass it back to you, Vishal.
Yeah, I appreciate you guys for having me. And yeah, you're right. We're none of us are going to be right about everything. I'm certainly not right about everything. I get a lot of stuff wrong. I like to think I get more right than I get wrong. But yeah, everyone's going to get stuff wrong. And that's the beauty of markets is that you're going to find a lot of different environments over just a 5-year period. Look how many markets we've seen, right? I mean, if you've been a new entrant from COVID, you've got a lot of market experience in 5 years. If you've been trading these whole 5 years, or even just investing, so that's a positive. That should prepare you. That level of volatility. But I'm being honest, really. I mean, even just this year, these are historic levels of volatility. Even if you've been in the market for 50 years, right, which none of us have. But if you've been in the market for 50 years, this is still historic levels of volatility, right? These are global financial crisis levels of volatility we've seen this year. So, I mean, you can stick it through this, either as a trader or investor. Good for you. If you could stick it through 2022 and the COVID crash and this as an investor, props. A lot of people have been either scared out of the market, rushed back in, scared out again, or uninvested, fully invested, on margin, out of margin. This has been the story for a lot of people over the last 5 or 10 years. And if that hasn't been the story for you and have been able to stick it through and do well, good for you. But what I would say is we've said most of this year with the P being cut, the price, no pun intended there, but the price has been cut on a lot of stocks. What we should hope for this earnings season, if you're a bull, is that the E doesn't get cut, because that's when stuff starts getting really bad. Now, I do expect this to be a very volatile earnings season. Obviously, we're headed into earnings season with pretty high VIX. I think VIX will probably pick up a little bit too when some of these bigger names report. You're going to see big names, big moves. You're going to see minus 20% moves on very big companies. Probably $100+ billion companies moving up or down 20%. You have to be prepared for that. I think you need to be careful about being heavy-handed with equity exposure during earnings season. The reason for that is because you put $100K into your favorite stock. If your cost base is close to the current price and you ride that into earnings, your stop loss isn't going to trigger if the stock gaps down 20% in after hours, and you're going to be stuck. With in that case, in that example, a $20,000 loss on a $100,000 position like that. Okay, and depends on how big your portfolio is, depends on how big your allocations are. But if you're somebody with a couple $100,000 in the bank and a couple $100,000 in your portfolio, that's a big loss. Okay, and that's kind of loss that not only can erase your year-to-date performance, but that's kind of loss that can discourage you for the rest of the year as well. So be cognizant of that. Be cognizant of the type of equity exposure you're taking. I know a lot of people on Twitter, say, well, options are risky. I don't want to use options. Well, in a high VIX environment, you shouldn't be buying options anyway. You should be selling them. But in the case where you are scared of options and you're like, oh, I'll take equity instead, understand that that's not always lowering your risk. Okay. If your plan was to take, $1,000 in call options and you say, you know what, that's too risky for me, I'm going to take $100,000 in equity instead. Well, if that position goes down 10%, you've already taken that $10,000 loss that you were too scared to take. So you have to be careful in these environments about capital allocation, not necessarily what assets you're buying, but capital allocation, being smart about portfolio management. I'm not encouraging people to use options, but in some cases, it may be better for your portfolio to say, hey, I'm going to take a $1,500 call position that gives me exposure to upside on this stock. If I'm wrong, I lose the $1,500, but I'm not exposing myself for 100 or 200 grand to the equity, where an earnings gap down, you're going to lose a lot more than $1,500, right? So understand the way you're inputting capital, understand the risk you're taking on in a highly volatile earnings season. Most people have not seen a highly volatile earnings season, especially over the last couple of years. So, be ready for that. Some people think that they're in a big name, a large cap name, so it can't go down a lot. Well, hopefully the last few months have dissuaded you from that impression, right? Because no matter how big the company is, they're down 20, 30% in the last few months, right? You're Amazon, which you guys know how much I love Amazon. It's down a lot, and the environment doesn't look great for them right now. Be absolutely clear. If we go into recession, Amazon's going lower, as are all the other Mag 7 names, as are most of the other big tech names. So be cognizant of that. Have a shorter leash. Manage your risk well, even if you're an investor. Manage your risk well in environments like this, because it's easy to get buried and it's easy to get carried away too. What's going to happen the first time we get a rally is everyone's going to chase it like they did last week. And you're going to have to be careful because it's going to be hard to know when we're actually at a true bottom versus a bear market rally. And in hindsight, we can go to years like 2022 and say, look how many bear market rallies there were, right? But if you bought any of them, you saw new lows. You could have bought the one in March, you could have bought the one in August, you could have bought the one in September. You got buried on all of them, right? So you have to be cognizant of that. And you have to, I think, be very, very, very careful with dumping your dry powder into this market. That would be my, if I would give any advice to anyone, that'd be my top line advice. Be very mindful with your capital allocation. Don't just throw your money at this market flippantly, because your cash is going to be your ally here. Your ability to navigate, your ability to move your money and find spots of strength is going to be your hero in navigating markets like this, is what I would say. So thanks for having me. I'm always open to come on here whenever you guys want to chat. And as usual, we'll see you guys on Spaces. So appreciate you guys having me.
Yeah, I'll just end it with a couple last thoughts. Yeah, I think those were wise words from both of you. I think expect volatility as a TLDR there. It's going to be an interesting earnings season. We probably get a lot more big tech earnings starting next week. I know we have Netflix, which is our first big report tomorrow. A little on edge just because I also still have my Magnite position. I've been kind of in and out of that name. They had, Netflix came out and basically gave their, I know we just talked about don't listen to management commentary a few years out, but they just gave their 2030 projections of like, they're going to be a $1 trillion company and all sorts of stuff. And right now we haven't seen any sort of tariffs affecting the digital side of the businesses.
Don't you think it's
And
kind of crazy for a company to give a market cap projection like that? Like, hey, we're
it's a
going to be
little
a
odd.
$1 trillion market cap. Like, what?
I don't get that, but again, like the reason why I'm still long Magnite at this point, going into a print like that, is because I don't necessarily think they're going to get acquired like anytime soon, but the influx from their ad tech business, like their ad tier is why Netflix is growing right now. They're expanding internationally, and you know that level of growth, um, that level of growth into a small Magnite of $2 billion size can be very meaningful. So I want to see what those numbers look like on the ad side. But yeah, I mean, we're kicking off earnings season. The banks are kind of boring. No one really cares. Nice to see no distress there. But yeah, prepare for volatility. Those are probably the last comments, and just keep things on a short leash. We talked about how use some of these moving averages on certain names that you're willing to swing as kind of like a safeguard. Like, hey, this is a trade for me. Most things I'm not married to right now. Like if I don't like something, I'm long in this market. But I'm the kind of guy who will go from 100% long to 40% net long in like 25 minutes. Like I will flip. I'm just treating it that way. And I know everyone has their own ways and everybody has their own stuff, but I'm very cautious. So like while I am swinging in a lot of places, I'm not being foolish in the sense of like, hey, if these things turn south, if things get worse, I'm listening to every bit of news and headline, and I'm actively managing my portfolio. And obviously, there are lower stress ways to do that, and there are better ways to do that. But everyone has their own thing that fits for them. So just do what's right for you. And at the end of the day, like if you can't sleep at night because you feel too much risk, like right now, I don't feel any sort of stress the way I'm managing. I feel okay and I feel good. So everyone has to do what's right for them. So if you're listening to this and you feel like you can't sleep at night, maybe that means that you have too much exposure. And a lot of times in bull markets, I feel I can't sleep because I have too little exposure. So it really just depends on the environment and how you're feeling. And so that's all. Vishal, Mr. Stock Talk Weekly, appreciate you joining us. It was a great episode, and look forward to having you on again. And to the listeners, see you next week. Cheers.